Yeah, I'm really thrilled about Texas, Neal. So let's finish off this webinar with a big question. What is the Ukraine war's impact on U.S. real estate?
All right, well, I'm going to start with this fantastic video. Hang on, if I can click on it.
Jay-Z, it's Tim. Thanks for joining us. And I don't want to ask you about the Fed because we're going to have a great conversation with Richard Fisher in a second. But I do want to ask you about the Fed in the context of a housing market you're very bullish on. And if I'm going to listen to anyone, I'm going to listen to Blackstone on housing. What part of this market do you get so bulled up on? You know, we had toll earnings a couple nights ago. We've had a lot of the home builders that are essentially trading at multi-year lows at this point, or at least through the lows of the crisis. And you have a case where housing conditions still on the demand side for them looks very good. Input prices are a problem. What part do you want to invest in?
Sure, it's a great question. And when most people think about housing, they're thinking about it two-dimensionally, which is the price of a house, the median home price, and rising mortgage rates. And you see median home prices hitting an all-time high. You saw mortgage rates backing up. The 30-year mortgage recently had hit as high as about 3.95%. And so for most people, they look at the median home price and they look at rising mortgage rates and they think about affordability. Well, I think it's a little bit more than just that two-dimensional calculation, because you also have to factor in rising wages. And so if you look at the median home prices today versus pre-COVID, if you look at how mortgage rates have backed up today versus pre-COVID, it is more expensive to buy a house and to finance it, and the monthly mortgage payment's gone up, but personal income has gone up more than the increase in the mortgage rates. So I think as we consider more housing and look at housing strength, I think it's important to consider that we have strong labor markets and rising wages. And historically, housing ends up being more correlated to labor than it is to mortgage rates. So where in particular, we've seen this out-migration to the South and to the Southwest. Those housing markets remain the hottest. And I think one of the permanent changes we'll see as a result of COVID is this greater flexibility with respect to, time in the office versus working from home or working from anywhere. And I think that strengthens the case to the South and Southwestern parts of the United States. I think they continue to do very well.
And I almost feel like I would be accused of passing this guy a $20 bill if he wasn't running a $300 billion portfolio, right? Because he hit all of the key points, right? I mean, number one, people only look at the fact that mortgages are going up and their payments are going up. No one's doing the math on how much excess earnings there are in the US, how much excess savings there are. You have to do both sides of the math. One side of the math makes absolutely no sense. That isn't math at all. And so he points out, and Goldman Sachs pointed this out. So I won't bore you with all the different articles because given like the PC is freezing up, but they're all saying the same thing. That and Marcus and Millichap and also Eminem actually specifically made this point. They said, look, when we look at the amount of pain that people are experiencing because of the pump, right? When we look at the number of dollars that people have to pay more in the United States, and we look at the excess earnings that people have gathered over the last 22 months of COVID, that pain is a very tiny portion of their excess savings. Even if they buy a home, you can't get rid of all of their excess savings. So the US is in this incredible one-time, never to be repeated situation where we have a very large amount of savings. So Google the savings rate in the US, because that's what's driving the fact that people are still buying homes. The Ukraine war has been on for 3 weeks, but today people are bidding like crazy on homes everywhere in the United States. Interest rates have gone up by a full half point. That matters a lot, by the way. Half point is a big increase in interest rates, almost 3/4 points. Doesn't seem to have affected any market in the US. Rents, when they came in for February, were still very strong. Granted, we haven't looked at rents after the war started. But when we are looking at the mathematics of this situation, it's still extremely, extremely strong. Now, one thing and by the way, he also once again pointed out the Southeast markets. So this is not nationwide. There's areas that are not going to do as well. There's areas that haven't done as well, like California. And then you've got areas that have done really, really well, like the Southeast of the United States. Texas obviously is by far the biggest beneficiary of high oil prices, high natural gas prices, and also defense spend because it has huge defense manufacturers. So when look at it on a state-by-state basis, definitely the Southeast makes more sense right now. So I love this video because he was so crystal clear about why he's continuing to buy, right? $300 billion of real estate and still aggressively continuing to buy. And by the way, they're very aggressive in the build to rent space, right? They, as you know, Blackstone created the build to rent space in 2015 because they created this concept of buy to rent. They bought 80,000 homes between 2010 and 2015, couldn't buy anymore, and invented build to rent. This is their invention. And they've actually done it. And they're now buying build to rent companies. So they're very, very bullish. And the biggest reason for it is this $6 trillion of stimulus that the US has that the Eurozone doesn't have, that Asia doesn't have, and the fact that we've got massive household savings in the US. So we expect that to keep things going. Now let's talk about the bad stuff. Are the interest rate hikes going to happen? Yes. Unfortunately, the Ukraine war took away the remaining doubt that I had, that everyone else had, about those interest rate hikes actually happening. So at this point, there's very little chance that the Fed won't hike 6 or 7 times. If a recession, if the US starts going into a recession, they'll slow down, but I do not see that happening. I think the US economy is very resilient right now. Household earnings are very strong. The labor market is very strong. I don't think we go into a recession, which means that the Fed doesn't stop. So I think that we could have either 6 or 7 interest rate hikes in the next 12 months. So there's already people that are listening to me right now saying, he's crazy. He thinks that we're going to have 7 interest rate hikes and real estate won't get hit. It'll get hit, guys. It'll get hit. Nothing, it's not magical. The question really should be, will it get hit enough for prices to drop? Will it get hit enough for cap rates to increase? And the answer, we believe, is no. Blackstone would be crazy. I mean, they've got all this money, billions in the bank. They would be crazy to buy today if they felt that, because they'd simply wait for a year. They have a 20-year time horizon for their fund, on a 3 to 5 year time horizon. So these people can just sit here and wait for prices to change, but they don't believe that they will. And anyone who thinks that 7 interest rate hikes are going to kill the real estate market, please look at the chart that I've in the past, shown before. Between 2015 and 2019, the United States raised interest rates 9 times. In 3 years, 9 times. There was no increase in cap rates anywhere in the US, and there was no decrease in home prices anywhere in the US. 9 increases. Now, I'm not saying that those 9 increases are the same as these 7 increases. They actually are not, because we're at lower basis. But I think that after 7 increases, we may see a slight bump in cap rates. I do not think that we will see a decrease in prices. Why? Because on the single family side, people have excess savings. Remember, people bought homes in the 80s when interest rates were 18%. So if you take interest rates up, well, mortgage rates, not interest rates, from where they are today and bump them up by, to 4.5 or 5, people will still buy mortgages. My first home, I paid 8.5%, and then I refinanced later. So I don't think that the single family market is going to worry too much about that. The multifamily market worries about 2 things. They look at cap rates and they look at rents. So here's a question. If you're going to assume that 7 interest rate hikes will hurt you on the cap rate side, it would be crazy not to assume that on the other side, 8 to 9% inflation would not boost your rents up. That's just, you're shooting yourself in the foot. So on this side, we are taking a big hit on the cap rate side. But on the other side, rents are going completely ballistic. And take a look at any inflationary time in the United States. You can look at the 80s if you want to. You'll notice that rents increase faster than inflation, right? So if inflation right now, and I think next month it's going to be at 9%, well, how can rents be at 3 or 4? And if rents are at 9%, how can real estate be a bad buy? That doesn't make any sense, because when you look at the prices of real estate, you multiply cap rates by NOI, and NOI is really a factor of rents. Yes, prices, you've got increases in expenses as well, but your expenses are here, yes, and your rents are here. So a larger increase is always going to beat a smaller increase. So we're in a good place. All of the documentation that I've read that is post Ukraine, at least a dozen articles from a dozen different companies, and often these companies are pretty bearish, by the way. Not all of them are bullish. Everyone's bullish. They think things continue. Everyone's a little skittish on saying that cap rates won't go up next year. Everyone's very decisive on saying they will not go up this year. So that's where we stand with, US real estate, both on the single family and the commercial side, Anna.